A few years ago, I worked for Mises Capital, the first family office fund to adopt a Bitcoin standard. And Mises helped fund the initial seed and Series A rounds of a number of Bitcoin startups that you see today. Now, while at Mises, I published an article titled Why Does Bitcoin's Price Make Random Sudden Downward Moves? Fitting for yesterday, as Bitcoin fell from 69,000 to 59,000, a 14% drop from the high to the low. Now, unlike equities, stocks, which tend to get traded aggressively on earnings days, days when a company's performance and future guidance fundamentally change, Bitcoin tends to be traded aggressively on seemingly random days. This strange phenomenon tends to confuse traditional commentators and journalists as they struggle to find any news piece that could have affected the price so drastically. Eventually, someone finds some possible explanation, and it immediately gets circulated as a result of confirmation bias. An example this time may have been an early Bitcoin whale selling old coins, or 2021 all time high buyers finally selling at their break even price. Although a number of individuals may be placing buy or sell orders based on one off news stories, they likely aren't the sole driver of the sudden Bitcoin price crashes that we often see. In reality, many people retweeting and spreading the news that Bitcoin's price crashed because of X, Y, or Z are simply being fooled by randomness. Although X may be one of the catalysts, the large downward moves are often driven by excess leverage in the system. Irresponsible people going 10x long right before the new all time high. For every buyer of a futures or perpetual swap contract, there must be a seller. However, the prices of those contracts change based on the market's balance between longs and shorts. If there are too many leverage longs on Bitcoin without simultaneous buying pressure in the spot market, the current price may be temporarily unsustainable. An over-leveraged market is similar to a Jenga tower built on a fragile base. If the funding rates in the futures contango are extremely high without significant buying pressure in the spot market, the Jenga tower only needs a slight push before it comes crashing down. These leverage liquidations result in a very ugly negative feedback loop. 1. Price falls. 2. Highly leveraged longs get liquidated, therefore sellers. 3. Price falls further. 4. Less leveraged longs get liquidated, more for sellers. 5. Traders see falling prices and jump on the trend. 6. Price falls. And 7 is repeat until the fragility of this leverage is ultimately eliminated. This imbalance, driven by the excess leverage, results in volatility. This volatility results in coins getting transferred from weak hands to strong hands that understand Bitcoin. After weak hands sell or are forced to sell, the price must adjust to the new equilibrium. A new base of strong holders is then built at a more sustainable price level, and then Bitcoin's parabolic bull run continues as it has for 15 years. This is all due to individuals converging on Bitcoin as a Schelling point because of its superior monetary properties. Bitcoin created a monetary game with the most superior monetary properties and an immutable supply distribution schedule. The only winning move in this game is to play.